Well, welcome back to another episode of Finance Uncut, where we talk everything finance and economics with an Austrian twist. On today's episode, I want to show you a couple of articles that talk about the recent dip in gold and silver, and also what the central bank's likely policy response is to the global economy. And coming in from Market Watch, Citi's global strategist says buy the dip in gold, but not stocks. It's been a rough September for the stock market. In its comprehensive look at markets, Citi's global asset allocation team doesn't expect the sailing to get any easier as it fears for the upcoming US election. A political process that cannot accurately ascertain its leader, parties refusing to accept results, and potential social disorder, all damaging credibility and lower the confidence of investors, especially in light of everything else happening in the background. Challenge to the rule of law would lead to a reassessment of historically safe US assets, including US treasuries and even the US dollar, even if only temporary, the strategist says. The next phase of the cerveza sickness related stimulus is likely to be a casualty of the Supreme Court vacancy, the strategists add. As the Northern Hemisphere enters a colder autumn period, an increase in cases is becoming evident, which both may alter human behaviour as well as government reactions, both of which could weigh on economic activity. The Citi's team does acknowledge the central bank put remains intrinsically tied to the equity market, and that there will be more Treasury bond and credit purchases and a desire to keep inflation-adjusted interest rates well below 1%. Yes, I agree. However, as someone who has always believed in the central bank put myself, some very smart people out there, such as Jeff Snyder, and even former advisor to the Dallas branch of the Federal Reserve, Danielle DiMartino Booth, kind of puts notion that the central bank put is simply a myth, that the Fed does not have the tools to save markets, to save the economy, that they just don't have the tools or the ammunition to do so. But they use psychology, so they go out there and they give the confidence that they save markets, and then people believe it, and so they run out there and front run the Fed, and so the Fed actually really doesn't do a heck of a lot. The people actually do it themselves. So the Fed use psychology, and if you want to learn more about that, just Google Jeff Snyder or Danielle DiMartino Booth, or go onto YouTube and watch a whole bunch of their videos as they discuss and talk about that. Anyway, let's keep going on here. So with all that as a backdrop, the Citi team says it makes sense to trim some developed market specific risk at a time when near-term probabilities are skewed to some regional economic surprises turning negative again, led by Europe. It advises rotating from European to emerging market equities, whereas it is overweight for the first time since the cerveza sickness crisis. Fundamentals for the dollar will remain unsupportive over the medium term, which will be another positive for emerging market equities, the strategist said. They're buying the dip in gold with check this out, a $2,200 target due to the heightened macroeconomic uncertainty, which is likely to push investors back into alternative cash preservation assets. And I'm glad they used the word here, uncertainty, and didn't push we think there's going to be inflation or deflation or any of this sort of stuff. Because this is one of the reasons why I've been heavily invested in gold and silver, in physical gold and silver, especially over the last couple of years as I've been accumulating, is the uncertainty. And with the just the massive amounts of global debt, be it government, corporate, or household debt. We see markets that are trading at multiples that are just nosebleed levels that have no correlation to the real underlying economy. You see the bond market where people are now happy to buy bonds and receive a negative yield simply because they think that there's going to be more demand for bonds, and the yields will get pushed even lower. and that the bond price will go higher. So they'll buy bonds at a XYZ price to sell it at a higher price. So that's the bond market's now become a speculative bubble in itself. And so where do you put your funds? Where do you put your savings? Well, you don't want to hold. Well, personally, I don't want to hold them in currency because we see what central banks and governments are doing with massive deficit spending and central banks, supporting that through whichever mechanisms. Different central banks have different rules, so the Fed operates different to the BOJ and to the Reserve Bank of Australia, the ECB, and so forth. So ultimately, they support the market interventions there. And so because of all that uncertainty, I like to hold precious metals because it's real. There's no counterparty risk. And it's got a history over not just years or decades or hundreds of years, but literally thousands of years. And coming in from Zero Hedge, the reckoning is upon us. Precious metal plunge is true dip buying opportunity. I just want to share some of the highlights of this article. The world is suffering from a debt overdose, which we just discussed. It now must face the inevitability of collapsing financial asset prices and synchronized fiat currency devaluation. We see the deficits. When we look at the deficits to the gold to S&P ratio, you can see, I think it was Jeff Clark from goldsilver.com did an article last week that showed the amount of currency creation just in the US versus the amount of gold and silver production from mining globally. So he used the global number for gold and silver production versus just the currency creation in the US. And if you haven't had a look at that, maybe go to goldsilver.com and you can find it. And it just shows how undervalued from that metric anyway gold and silver is. This chart is quite interesting. Here in the red line shows the percentage of ownership from foreign holdings of US treasuries, and you can see that that's been going down and really sharply lately, and that means the Fed has to pick up the slack there. US household wealth to GDP, don't show this chart to anybody who's just lost their job around the world due to the shutdowns. There is only one way out: monetary debasement. Well, they could default. That's an option as well, I guess, but will they? Who knows? What's interesting is the median free cash flow of gold and silver miners. Some really bright people say that this is one of the reasons why Warren Buffett has invested into Barrick Gold, because Warren Buffett likes companies that produce lots of free cash flow, and that's certainly the case. However, look, Warren Buffett for the last 3 or 4 decades has been bagging gold all the time. So for him to actually invest into Barrick Gold, almost $1 billion worth, yes, fairly small position compared to his overall portfolio. However, for someone that's been bagging gold for a long time, it's an interesting play. And yes, they do produce very good free cash flow, but you also have to believe in that underlying product that business has, and so that means he must be bullish on gold. He wouldn't be buying Barrick Gold if he thought that gold was going back down to $1,000 an ounce. This is just charts from Crescat Capital, their performance. This is an interesting chart as well. This is the Fed balance sheet in blue, and the gold silver index in, well, gold, yellow, whatever. And when I have a look at some of the periods where I was buying gold and silver, I've certainly done very well over the last couple of years holding gold and silver. But what I really wanted to show you was this bit here. So We believe there are 6 structural forces that will pressure the Fed to further expand its balance sheet at new record levels and propel undervalued gold and silver prices much higher in the near term. The stock market bubble bursts and the Fed must intervene. That's number 1. Number 2, the Treasury needs the money and the Fed must intervene. Now, remember that there's $8.5 trillion in treasuries coming due by year end, so they're maturing by the end of next year. And a record budget deficit that must be funded. So we are expecting that the Fed balance sheet to hit 10 trillion by next year. 3, left to their own devices, interest rates start rising and the Fed must intervene. 4, unemployment remains too high and the Fed must intervene. 5, inflation remains too low and the Fed must intervene. 6, the dollar keeps strengthening versus other fiat currencies and the Fed must intervene. Obviously, as a believer in Austrian economics, we believe in the free market, and history is on our side regarding that. However, free markets do not exist. Capitalism does not exist anymore, and we know that governments and central banks will intervene as much as they can, which will make the problem even worse. But these are all tailwinds for precious metals. Here from CNBC, 61% of Americans will run out of emergency savings by the end of the year. Also here, Chicago Fed President Charles Evans warns that more fiscal relief needed to limit further damage to households and businesses. So there we have it. What do you think? Do you think that governments and central banks will continue to intervene into the market? Do you think that they will continue in the Fed's case, print more bank reserves? Ultimately, central banks supporting government deficits. And what do you think about precious metals? Obviously, I've been accumulating precious metals, physical precious metals, for the last couple of years, and in a much larger way since September last year in particular, and I've shared that in other presentations that I've done. But this year I've been focusing a lot more on the miners, especially the junior miners and explorers, and been accumulating a lot of positions out there. And I'll continue to do so. But for me, I just don't have the confidence in the system. As I said, the amount of debt levels, I don't think can be paid back. Where do we go from here? I know they're not going to allow the free market. Either they let that happen and we have a deflationary bust, which is what we need, where we deleverage this debt bubble. I believe they'll keep trying to pump more into the system to keep the bubble up, to keep it going. And look, they may even say, hey, what the heck, let's just go MMT. We got nothing to lose. Let's just try it, see if it works. If we have a super hyperinflationary environment, well, sweet. We're gonna reset. I believe we see. Those from Davos, the World Economic Forum, pushing for a global reset. There will be some sort of reset. I hope those guys don't get their way, because that's great for the elites, but it's not going to be great for the average worker. Obviously, being a supporter of sound money, I would love to see us go back to either a gold or silver standard of some type. But I do think that the days of this fiat currency, US dollar, being the reserve currency is numbered. But I guess time will tell, and we'll see whether I've made the right call or not. But I just want to thank you all for joining me today, and I'll see you again on another episode of Finance Uncut.